What's good, everybody? Mokama Sunday Service. Today, we are going to be talking about my best strategies for options trading, especially if you're trading as a beginner. Like this is kind of how I started, and so we're going to be going over some like very basic strategies. But I would say even like how I'm going to teach them today, it's going to be like very minimal, kind of like starting off, but I probably have a lot more indicators, a lot more rules now than what I used to have. But I'm just going to go over four basic strategies and like how I use them. Number one, this is what I started with. It was like the easiest way I think to trade. Open range breaks. This is more of a short term day trading strategy. It's a momentum strategy. I don't use momentum strategies as much anymore, but I might revisit them this year. Probably not so much open range breaks, but the second one that we'll talk about, open range breaks are easy because it's just a market opening trade. So like over here in the West Coast, the market opens at 6:30 a.m. East Coast 9:30, right? So you're just waiting for a range to establish in the first 5 minutes, 15 minutes, 30 minutes, right? I prefer to wait at least 15 minutes because if you watch the market, especially if you're trading something volatile like a Tesla versus like an Amazon, which tends to be more steady, doesn't make like huge moves all the time. That first 5 to 15 minutes can be rapid oscillations back and forth, buying and selling. Some people clearing out trades from the day before, that sort of thing. So really, it's hard, or I would say not even hard. It's more volatile to trade something in the first 5 minutes, or sometimes people trade the first 2 minutes, right? And that's really fast. So you really need to know what you're doing if you're trading like these lower time ranges. But after the first 15 minutes, after the first 30 minutes, stocks tend to, I would say, like become more trending, or they kind of smooth out. And this isn't always the case, but like they tend to smooth out after the first 15 to 30 minutes of the market opening. So generally, like a safer range would be a 15 to 30 minute range because the market is probably going to be trending one way or another after that particular time. And once again, that's not always the case. And the strategy would be to trade the breakout or the pullback to the breakout point. You always want to set a stop, ideally on the other side of the range, and then you still want to look out to see if the market or the sector that you're in is trending, right? So if I'm trading Tesla, I'm probably going to be looking at Amazon and XLY. They're in the same ETF and they kind of like go together. So like what is the XLY? What's the consumer discretionary sector looking like? And I know that that's a big component in the Nasdaq, and Tesla is a tech stock. So like is tech doing well too? And Tesla's kind of a bad example because sometimes it trades the exact opposite of what the sector is doing. But specifically, that's kind of what you're looking for. Is this breaking the range to the top or to the downside? If it breaks the range to the top, you could buy calls. If it breaks the range to the downside, you could buy puts. You could sell call spreads if it breaks the range to the downside. You could sell put spreads if it breaks the range to the upside, right? You could even buy shares or sell shares, right? The trading vehicle doesn't matter as much as the actual strategy to take the breakout, right? And this is a momentum strategy rather than like an exhaustion strategy. So let me go to Thinkorswim and show you what I mean by an open range breakout. Can you guys see my screen?
Yeah.
All right, so I'm going to Tesla, and if you're trading open range breakouts, you're probably going to be on a 5 minute chart. If you're not on a 5 minute chart, other than to kind of zoom out and see what other things are doing, like you don't know what you're doing. So what I mean by open range breakout, so we get here, you see where this shaded region ends, that is when the market is opening right here at the 6:30 candle, right? 6:30 here. If you hover on it, it'll tell you pretty much it's a 6:30 candle, right? So basic candle structure for those of us who are beginners, you have a green candle. This edge right here is where the candle opened at 6:30 when the market opened. This was the low of the candle of this 5-minute candle. This is where the candle closed, the top of this fat part of the bar, and this was the high of the candle, right? So essentially at 6:35, the price was right here. For red candles, the opening is at the top right here of this fat part. The close is at the bottom, and this is the high and this is the low. So at 6:40, this was the price of Tesla at this particular mark, right? So when you're establishing a range, I usually go get my tool right here. I'm going to go grab the price level tool. And so if I'm doing a 15-minute open range, I want to go figure out, hey, and this is real. If I were doing this real time, I would essentially be waiting for these bars to open and close, these first 3 5-minute bars, because we are on a 5-minute chart, right? 3-day 5-minute chart. I would go look for the top of these 3 bars, which is right here, and then mark that off, right, as a price level. Then I would go find the bottom of these 3 bars, which is right here, and mark that off as a price level. And so what I would be looking for, I would have entered this trade if I were using an open range break strategy right here on this candle that broke this particular range. And I would have either shorted shares, which I don't do. I probably would have bought puts, or I would have sold a call spread right around here, right, once this broke. And so essentially that's what you're looking for. Like if you had consolidation over the first 15 minutes, you set your range, and then you take the breakout. And so that's why I say there's caveats. Like I would have wanted to know what XLY was doing on that day. And so I have my watch list up here, right? And I don't know what this was doing right around this time. I don't know what the NASDAQ was doing in the first 15 minutes. And so depending on what the NASDAQ was doing, which is all the tech stocks primarily, depending on what XLY was doing at that time, if they were both down, I would have felt more comfortable shorting this or taking puts at this particular range break, right? And so what I've seen personally is that this strategy works better in a trending market, whether it's trending down or it's trending up heavy. What I don't want to see is sideways action, which is actually what it did. If you would have took this down here and got out here, you would have been gravy. But if you would have held it, it came right back within this range and just consolidated the entire day and went nowhere, right? So this is kind of what a sideways market looks like when we're talking about, like, this is the established range in the first 15 minutes. And at the end of the day, the stock is still within that first 15 minutes, which means Tesla was pretty much consolidating most of the day, except for this break right here, right? Let's go look at Amazon as another example. If you look at the first 3 candles of Amazon, all right, let me zoom in just a little bit. 1, 2, 3, 5 minutes, so that's 15 minutes. So if we create a range, and essentially depending on what was happening in the market, right, for me, same thing, I would have taken this break right here. Taking this break with puts, you could short shares, you could sell call spreads right at this break. But once again, it came down, kind of came back up into that range. So it depends on where your target was, where you would potentially sell, right, as to whether or not you made money on Amazon. And once again, I would prefer this to happen. I'm sorry, I'm scrolling back. I would prefer this to happen on a more trending day in the market. So if the entire market is trending down heavy, I would be more likely to take Amazon to the downside. But as you see, it pretty much did the same thing that Tesla did. came down, if you would have got out here, had a short target, you would have been good. But if you would have held it, thinking that it was going to go down a little bit further, right, it came right back up into this range. And where I would put a stop would probably be at the top of this range. So I might potentially still be in this trade, or I would have got out right at the end of the day around, a little bit less than break even, especially if you're trading options. And depending on what your expiration date is, right? So same thing just in terms of setting stops. Like a good stop, the same thing with Tesla. If you would have set a stop right here at the top of the range, it never broke that range. Tesla was just consolidating the entire day, right? So that is an open range break trade. If you are in a sideways market, then it's difficult. A sideways market is difficult for damn near any strategy, for an exhaustion strategy or a momentum strategy. Ideally, you want something to trend and keep going that direction. I don't care if it's going down or if it's going up. The most difficult things to trade are trading things sideways, and condors are like best for that, but I don't really trade a lot of condors and butterflies, at least not yet. So that's probably the last tool that I need to get underneath my belt, is trading something that goes sideways the entire day and making money off time decay. But that's an open range break strategy. So that's strategy number one, right? That's very basic. And like I said, you could play 15 minutes, you could play 30 minutes, you could play 5 minutes, you could play 2 minutes. It just depends on what you're doing. You could also use volume or RSI, the RSI as an indicator, maybe only taking things that are more exhausted to the upside or the downside, making sure it's in a sector that's trending. These are all other rules that you might use to say, hey, I'm going to take this trade versus I'm not going to take this trade, right? Especially if I see a Tesla, maybe not Tesla, let's say if this were like Apple and it's like the tech sector, right? Apple or Microsoft. If I see the tech sector going up and Microsoft is breaking to the downside, it's going against the stream. It's going against the current. So that's another reason why I might not take this break to the downside, is if everything else in tech is going up, then that's an indication that this might just be an aberration and it's probably going to come down and then come back up too, right? So just rules for open range breaks. Something I might be looking for more this year, not as much as this next strategy, but because I feel like I have a better feel for the market, I could probably do a little bit better with this strategy if we get back to a roaring bull market, or if we see like a severe pullback. Then I might start using this and getting some money on the downside every day, right? All right, let's go back to next strategy. Inside bars or candles. This is also a short-term to medium-term strategy. You can use this for swing trading. This is also somewhat of a momentum strategy, meaning that I'm looking for a break of the top or the bottom of the inside bar or candle. This is one that I really want to revisit, because when I looked at some of my trades last year and the year before, I was doing pretty well off trading daily inside bar candles, so I probably should have stuck with that in some of my swing trading. And these things don't pop up all of the time, so it's not like a trade where I'm trading it every single day, especially based upon my particular rules. But I'm going to be looking for these a lot more, and specifically the way that I look for them is I scan for them. I'll probably do a video on this. I may have actually done one way back when on how to build a scan for an inside bars. You could do it manually, because I really only trade liquid or highly liquid stocks. I like big market cap stocks, things that are making billions in profits or hundreds of millions of dollars in profits, right? That people are trading rather frequently. High market cap stuff. No low caps. I don't even trade a lot of mid-size stuff. I want things that are traded frequently, that have options that are traded frequently, so that way I could hop in and out of the stock really, really quickly, right? And for inside bars or candles, you're trading the pullback, or trading the breakout or the pullback to the breakout point, right? Same thing. I always set a stop, as I've told you guys plenty of times. Do not put on a trade if you don't know where your trigger is to get in, your place to sell if things go well, and your place to sell if things go bad, right? If you don't have those three things, don't enter into any trade. And then the last thing, same thing. I'm looking at what the market looks like. Is it trending up? Is it trending down that day? Is it sideways? What is it doing? And is this at a point of exhaustion where we just had a big drop and then we had an inside bar, or we had a big candle up and then we had an inside bar? Those are things that I'm looking at when I'm trading inside bars, right? And so I'm going to show you what an inside bar is, because I have a feeling you guys are like, what is he talking about? Go to my scanner. So like, this is my scanner for inside bars, right? I created it. There's this tool in here where you can tell the platform, like, what you could define an inside bar for the platform, and then it'll scan for you, right? So I did that. Like I said, I'll make a video on that if I haven't already. And then when I scan for that, it's going to give me all of the companies that have had an inside bar. I wouldn't trade any of these, which is why I said this trade doesn't pop up as often. Even though we have inside bars on all these companies, their market caps are really small versus like a Tesla or an Apple or an Amazon or something like that. They have small market caps. So I don't tend to trade things with small market caps, but I'm going to use them as an example because this is what came up on my scanner, right? So if I go to my chart, what was it, AEE? Go to a daily chart, because I mostly trade inside bars on daily charts. This is me, not everyone. This is what I mean by an inside bar. If you look at the candle before it, right, the day before, this is the bar that we're talking about. It is inside the high of the candle before it and inside the low of the candle before, right? That is an inside bar. And what does that mean? That means that we had this period of consolidation. And usually after a period of consolidation, then you're going to have a big move to the upside or to the downside of this new candle, right? At least in my experience, that's what I've seen. And I like inside bars that actually aren't as wide as this. Like if the range were like here and here, that's even better. Like, because really, when you're looking at a chart, and we're talking about technical analysis, what this bar is telling you is that there was a fight on this day on Friday between the sellers and the buyers between this very narrow range, right? Which means that it seems that when it gets down here, people are buying, and it gets up here, people are selling. And then they were fighting the entire day. And then this prior candle is showing you like the prior fight the day before between the buyers and sellers. And so now we have this period of consolidation, this inside candle right here. And so what I would do, let me take, so now I'm going to draw a range from this inside candle. And if I were to trade this on Monday, I would be looking for a break of this range to the bottom where I would buy puts or sell call spreads, or this break to the top where I would buy calls or sell put spreads, right? Or buy stock, right? Upon this break. This is also momentum strategy. Once again, if I see a big candle right here next to the inside candle, I want this inside candle to be as small as possible, which just shows like extreme consolidation. And then hopefully the day before at 6:30, I'm looking, and hopefully it's still consolidating within this range, and then I'm waiting for it to break to buy. Or if at 6:30 in pre-market it's already broken this range, I'm looking for a buy if it pulls back to that same level, right? Let's go look at one more. Scan. Let's look at ACIW. I don't even know what that company is. I'm just trying to see here. Here's another inside candle, right? So inside candle, day before, top high and a low, and then we got a candle. And this one I really like because it's a really tight consolidation. So if I draw another level there, and this is what I'm looking for. I'm looking for a break to the upside or a break to the downside and taking that. And so for me too, these highs and these lows on these previous candles, those are potential target number ones, right? Because you're going to see, if you see here, you see here, that's going to serve as a floor potentially for any trade to the downside, because you got two candles there where it hit that low and bounced up. So if I were to trade this to the downside at $50.88, my first target at least is going to be $50.23. And then if it breaks that level, then yeah, it could keep going. Same thing to the upside. My target here is going to be this high here. So there's not that much room to the upside, which is why I said I prefer big candles next to these consolidation candles so that it has more upside or more downside, right? Let me look at one more. ACVA. Let's see if there's an outside candle. Same thing here. You got a consolidation candle, but it's not. I wish it was further down and not as big as this particular candle. But same thing, inside candle, right? Extreme consolidation, price action, which shows a fight between the sellers up here and the buyers down here. So if it breaks this level or breaks that level, right, there's a good chance that it's at least going to come up here, or a good chance that it's going to come back down here and potentially keep breaking that level, right? So once again, if you're looking at the sector, let's imagine this was Amazon, or imagine this was Apple. If the tech sector is down, then I'm going to feel more comfortable with this break to the downside. If the tech sector is up and this is breaking to the downside, I'm not going to feel as comfortable with it because it's going against the grain. But if everything is going up and this breaks to the upside, I'm going to feel more comfortable that this is going to break to the upside, especially if it's a laggard. If the tech is up and it's lagging in here at 6:30 or 7 o'clock, and then, you know, it's Amazon or Apple or something in the tech sector affected by the tech sector, I'm going to feel more comfortable in that break to the upside, right? So that is inside candles or inside bars. I want to look for an outside bar just so I could show you in comparison. Oh, I think I found one. This is what's considered an outside bar. There's a strategy called the Strat. The guy that invented it passed away recently, but there are a lot of YouTubes on it, right? So they pretty much trade candlesticks. So I showed you what's considered a 1 bar, which is an inside candle. This is what they would consider a 3 bar, which is an outside candle. This is a candle that kind of breaks the norms, where you see the candle before it, it breaks the top, the high, and it breaks the low. These are very hard candles to trade because this is a day where everybody could get washed out. If you took this to the upside, you lost if you held on. And potentially, like here, it depends on where you bought it. Even if you bought it here, yeah, well, no, it ended here. So even if it's just one of, like, you would have had to catch it at one of these extreme edges to make any money, but it started here. So like you would have had to catch this at an extreme edge, even though it broke this top, like it came all the way down, right? So this is like a huge volatility day. And a lot of people get washed out in a trade like this on an outside bar. They happen. They don't happen as often, just like inside bars don't happen as often. But like you got to watch out on days like this where you see you break the high and the low of the previous candle. That's going to be an extremely volatile day. That's called an outside bar. I tend not to trade so much on an outside bar unless I can catch one of these edges, right? From an exhaustion standpoint. So like I wouldn't trade an outside bar with this strategy. This is primarily an inside bar strategy. When I'm trading outside bars, I trade them with my third strategy, which is what we're going to kind of talk about now. Where are we? Where's... Bam. Exhaustion and mean reversion. That's the third strategy, right? So stocks go up and down. ETFs go up and down. Indexes go up and down. They don't tend to just head up and only go up. Yes, there are times where it can run 3, 4, 5, 6, 7 days, right? Green candles. 3, 4, 5, 6, 7 days, red candles. But they tend to oscillate up and go up and up and go up, or down and go down and up and go down, right? So, with that said, you can generally take advantage of a stock reverting to its mean if it's exhausted to the upside or downside. This whole last year, this is the strategy that I was trying to perfect, or at least learn, right? So I want a trending stock and a trending sector. I'm looking for a big pullback candle, whether it's red, meaning if something is trending up and then we have a big red candle down, I'm looking for an exhaustion point to try and hop into the stock. If something is trending downward and has been trending downward in a down sector and it has a big green candle, then I'm looking to short it or buy puts at a particular level if it has an up day, right? I'm looking for something that's past, at, or near its true range. And a true range is just a measure of volatility, right? Tesla's true. Yes.
Sorry to cut you off, but your screen is like, at least on my end, it's blinking like a white stripe.
Okay, hold on. Is that better?
Yeah, there we go.
All right, my bad. All right.
There we go. Yeah.
Exhaustion and mean reversion, my bad. So I'm looking for a trending stock in a trending sector. A big pullback candle. If it's trending up, I'm looking for a big red candle. If it's trending down, I'm looking for a big green candle. Something that's past, at, or near its average true range, right? Meaning Tesla is going to have a higher average true range than Amazon because it's more volatile. You'll know it's more volatile because if you study Tesla, the candles tend to be big, right? If it goes up big. If it goes down, it tends to go down big. Amazon tends to be steady as she goes. Walmart, Costco tend to have smaller candles, right? They tend to be more steady, up and down. So you're looking for something that's past, at, or near its true range, meaning this stock tends to move, let's say over the last 2 weeks, no more than $5 or no more than $1. So if it's moved $5.50, it's probably exhausted to the upside or downside. On a stock that tends to move $1, if it's at 90 cents or $1 or $1.05, it's probably not going to go that much past that from a statistics standpoint, right? You could have a day that's an aberration and an anomaly, and that always happens not always. That happens from time to time as well, but statistically, if this stock tends to move $1 and it's already moved $1.25, chances are like you could be trading it to the opposite side because it's probably exhausted, right? So that's my strategy, is to try and trade at a point of extreme exhaustion and then set a stop, right? That's always a portion of it, right? So now, once again, let me show you what was something that I was looking at. Oh, right now, and we'll talk about this for swing trading. A lot of things are trending down right now, specifically in the metals and mining sector. So one that I'm looking at to short is Alcoa, something that I made some money on last year, to the upside, right? This is trending down. How do I know it's trending down? It's making lower lows from a technical standpoint. This candle, this is a low, and it pops up from there, and then it comes down and breaks that low, right? Pops up again, and then it breaks that low again, which means we have a negative trend currently, right? If you look at the trend, you draw some trend lines, which I don't really do anymore, but just so you guys can see, right? That trend is heading lower, right? So what am I looking for on this, for an exhaustion strategy or mean reversion strategy? So If this trend is negative, and I know that also metals and mining XME has a negative trend. So and Alcoa pretty much is a mining company. I'm looking for this to have a big green candle day. And I've already kind of identified the level that I want to short this at is 38.51 because I've looked at the volume here and there's a lot of volume here as well, which means that there are probably a lot of sellers camped out right here at this mark. So I'm looking for a pop up to this level or close to it, and then I want to buy puts or sell calls on Alcoa potentially next week if we have a big green candle up here because it's in a negative sector that's been trending lower, and I want to keep beating up on the weak name. As well as from a seasonality standpoint, January tends to be a weak month for the market, so I'm not expecting huge returns in January to the upside. I'm expecting downside. So from where the river is flowing, where the current is flowing, at least in metals and mining, Alcoa looks negative, right? So that's what I'm looking for. I'm looking for uh, a pop up, a green candle to be exhausted to the upside, and then I'm going to short it down. I think, did I do one on NEM? What was the other? No, FCX. Was this the one I missed? This is the one I missed on Friday. I'm pissed. Because I had a level here, but I did set an alert, or I was working and went off and I just wasn't paying attention. It hit my level and bounced all the way down. I would have been out of that trade by now. Like, I called it like to the T. Like, this is one that just hurts me. Where it was something I was looking at. Freeport is also in the metals and mining, right? And I know metals and mining was the worst sector over the last 30 days. And so I know this is trending down. I had my level. If I would have just bought puts right when I said I was, it came down like to like what almost like $2. I would have already been out scaled out of half this trade already. Would have made some good money on this. Same thing with XME, the entire sector. I'm looking for a big green candle push up here to potentially short it because this whole sector is coming down. Also, this 34 is a good level too, like as a good ceiling for this, right? Which would be some resistance, and then around $60, some good resistance. Looking at this candle right here, so I'm looking for a big green candle up to this level potentially sometime next week, hopefully Monday, and then that's another potential short position that I would take on the entire sector, right? So that's an exhaustion trade. Typically, if you watch this channel, I'm talking about exhaustion trades or big red candles and then to the upside. But right now, I see a bunch of weak sectors in the market. So I'm looking for big green candles and shorting to the downside. I will probably exit these trades a lot faster just because short positions don't tend to last as long as long positions because over time the market tends to go up. So I really don't want to be in my short positions for longer than like maybe a day to a few days, and then kind of monitor it. At least scale out probably a lot faster than I would if I'm buying calls or selling put spreads, right? So that's what I mean by exhaustion trading. Huge moves to the upsides or downsides, and then hoping that the trend continues at a major level in the direction that the stock was already going, right? Because if you look at XME is headed down. So I'm waiting for a big pop up, and then hopefully it keeps heading down. Okay. All right. Why is it tripping? Hold on. Just doing the same thing that it was just doing.
And would you buy puts in that situation?
Uh, it depends on the liquidity of the stock. So I prefer, as I've said, I prefer to buy spreads, or sell spreads. But sometimes the liquidity in the option chain doesn't allow me to sell spreads. So if I can't sell spreads, then yeah, in this case, I would buy puts. I would rather sell a call spread because that's a less risky trade, um, because time decay is on my side. So if I see the option chain and it's really liquid, and like at multiple strike levels, then I'm going to be more likely to be able to sell a spread. If I only see like one strike price or a couple strike prices that are maybe 3 or 4 strikes away that are liquid, then chances are I'm going to have to buy puts. So actually, let me go back. Let's look at XME specifically. So if I wanted to buy puts on XME, and at what level? At $60. So let's go look at the 60 strike. It's liquid. Couple strikes away from that, liquid too. Oh no, but look at the difference between the bid and the ask. It's $5, $4. So, and this might be because the market is closed. I would look at this when the market's open. Another one of my rules, as I've said, is I don't like big spreads between the bid and the ask, more than 10%. This is like 90%. So, specifically at this expiration date, January 17th, I probably wouldn't be able to trade it. So, maybe looking out, there's no liquidity. So, January 17th, unless this spread like comes closer together, XME would probably not be on my list to trade. But this could be because Thinkorswim updates on the weekend and the market's not open. If this closes to between like 40 cents, then this is potentially viable to sell a put spread because you got liquidity over 1,000 at this level. Also, and actually even up here, you got liquidity over 1,000, but let's say if there were no liquidity, then you could just buy puts. And let's look at Alcoa, because we also do have OPEX on Friday. And see, looking at Alcoa, they just have liquidity at certain strikes, right? So look at this. It's illiquid, but at this 40 strike, it's mad liquid, right? Which is actually, so yeah, I would trade Alcoa, but I could only buy puts at this 40 strike. As you see here, the difference between the bid and the ask is only 20 cents, which is less than 10% of $4, right? So this has liquidity, so I would trade Alcoa over XME, but I couldn't take Alcoa with a put spread. I couldn't sell a put spread because there's no liquidity near this strike, but I would probably just buy puts at this 40 strike for me, which will be less expensive as this moves up closer to $40. These puts will probably be close to like $2 by the time it moves up $2, like where this level is here, right? And so this is just like me reading the option chain. So I can even anticipate if I had a budget of $1,000, I know I'm going to be able to buy approximately 5 of these once it gets about $2 higher at that 38 price point, which is where I want to buy it at 38, or where I want to, I buy these puts at 38.50 approximately. Wrong button, stop. You feel me? Does that make sense?
Yeah.
So it's like the more tools you have in your belt too, like you could tackle something a lot differently. That's why I'm trying to learn butterflies and condors now too, right? Like, so I don't just have to buy shares. I don't just have to short shares. I don't just have to buy puts. I don't just have to buy calls. I can sell spreads. And like you can take some of the risk off of a trade. If you're not as confident in the trade, maybe you take some of the risk off by selling a spread, rather than buying less of something. Same thing, or you can just, hey, I know if Alcoa hits my target trigger or hits my trigger next week, I know I'm only going to be buying puts because I just looked at the options ladder, the option chain, and realized that, hey, there's no liquidity or there's not sufficient liquidity to sell a spread. So I'm probably going to be buying puts if I get into Alcoa early in the week before option X, or OPEX. Same thing, another lesson that I learned last year. OPEX is on Friday. So if Alcoa triggers on Wednesday or Thursday, I might stay away from it because I only got a day or two for that thing to go in my direction before a big volatility point in the market, which is options expiration, the third Friday of every month. So I might wait for that to trigger late on Friday if it doesn't trigger on Monday or Tuesday, because I'm not going to have that much time before a big volatility point in the market, right? So like I'm giving you guys these strategies, but there are also other things that might prevent me from taking a trade, just based upon my experience of being in the market, or what's coming up. Like, is the Fed chair speaking? Um, is there some big jobs number or inflation number coming out that's going to affect the market? So I want to be in a trade earlier, so I'm waiting for Alcoa to trigger on Monday or Tuesday. But if it triggers Wednesday, I might be hesitant to take it if the Fed chair is speaking on Wednesday or Thursday or something like that, right? So like all of these strategies come with caveats that with experience you might learn when to take a trade or when not to take a trade based upon your risk parameters, right? So the last strategy, option leaps. And we've been talking about this. This is more of a long-term trade, a long-term swing trade that I also use as like an exhaustion strategy, right? I'm looking for something with good value that is down, right? I don't really trade options to the downside because once again, over time, I think the market is rigged to go up. So yes, you might have these periods of corrections and downside, but we tend to come back and we tend to bounce back. So if options, I'm usually trading a year to a year and a half out. Over a year, I expect the market, to have gone up, especially if I'm trading a stock that is already exhausted to the downside, that is already a good value. Number one, and I've talked about this, I haven't talked about fundamentals in these other three strategies because they don't matter as much. When I'm trading leaps, if I'm going to be holding something for 6 months to a year and a half out through earnings, I want to make sure that the stock is fundamentally sound. Is it making money? Does it cash flow? Is it growing earnings? Does it have good management? All of these things. What are the assets to liability ratio, right? Is this something that can weather a downturn in the market or a war or whatever it is that could potentially come? Is it fundamentally sound? Because if you're holding these through multiple earnings periods, you better make sure that this is a stock that's actually going to be making money. And I know Tesla has been up, but Isaac, this is specifically for you. I know you're a Tesla fan. Like, their deliveries are crap, right? If you've been paying attention, like, Tesla's deliveries have been crap. And it's fundamentally a car company to me. Yes, it is a tech company, but it's a car company. And yes, he has the ear of the president and might be getting his subsidies and whatnot, which is going to help it over the next couple of years. But like, it is delivering less cars than it was last year. So that's why for me, like, I understand you can get some alpha out of it, day trading, swing trading it based upon what the market is, but doing a leap on Tesla, man, it's just too volatile for me to trade. So, and I even think maybe in 5 to 10 years, just because like I think Elon is a genius. Forget what you think about his politics and how crazy he might act. The man has started like $4 or $5 billion companies, right? If not started, took them to $1 billion companies, right? We're talking about SpaceX, uh, Tesla, PayPal. What's the other one right now? The satellite company, Starlink, the Neuralink company. Like, the man has created $5 or $6 billion companies, and he owns X or Twitter now. So it was hard to bet against the guy. My problem with Tesla is I don't know if he's building everything inside of Tesla. So will Tesla be able to take advantage of all of these technologies that he's coming with or building, or is he going to keep those companies private or completely separate from Tesla? So it's like, just because he's building all of these great things, is Tesla going to be able to actually take advantage of that stuff? Or is he just going to break it off and start a new company? I don't know. But with leaps, trade at a point of extreme exhaustion with a discount, ideally 25% to a 75% discount. Once again, who cares if we're at an all-time high? If you would have bought Nvidia last week close to the all-time high, you would have been disappointed because it's pulled back, right? So always buy something on a pullback, ideally at 25%, and in a really ideal world, 75% discount using Fibonacci levels or retracements on a 5-year chart. That's what I use. You could use a 1 year, 2 year. I use a 5-year chart, right? Because some of my options I might actually want to turn into shares, right? I'm trading something with a high delta, not something that is at the money. Go look at some of my prior videos to get an explanation on that, right? Something that is higher delta in the money because it has less time decay associated with it, and then ideally something that's more liquid. I I generally want something with more than a thousand of open interest, but you'll see that leaps are a little less liquid, so I'm kind of changing my rules to where if it has over 500 open interest, I'll take a high delta option, right? And then my options, these I don't really have major stops for because I usually put these in my retirement accounts, but I'm trying to hold it at least until like 3 months before expiration. I might scale out of them, but I'll at least hold my last position, which entitles me potentially to 100 shares, at least until 3 months before expiration, and see where it is. Like with my Google options right now that I've had for I think maybe 6 to 9 months now, because they're up so high, because they just had that breakthrough in quantum computing, which means they're in the lead right now for quantum computing, which I believe is going to be the next sector like I might want all of those shares in 3 different accounts. So I control 300 shares of Google. I might want those to turn into shares and just hold those for the long term because I believe in the company. Same thing with my Shopify shares. My bookstore runs off Shopify. I think it's going to win the online consumer wars outside of Amazon, right? And so I think it has a long way to grow. And so I might let those turn into shares as well because I've already scaled out of that position twice in 2 different accounts. So I've actually made a decent profit off the actual leaps, selling the leaps, and I might hold on to the last 100 shares that I have and just tuck those in my retirement account because I actually believe in the stock, right? So once again, let's go to the charts, show you the leaps that I'm looking for, which I've already talked about. LVMHF. I feel like somebody watched my damn video too because some of these stocks took off the day after I talked about them. Like literally the day after they took off. LVMH, I'm looking for a leap on that. If it's liquid at around $600, if it can get down there. So once again, I'd go look at the option chain. Oh, no, wait, I gotta buy shares. LVMHF doesn't have options. That's crazy to me. All right. So if I take LVMHF, I gotta take it with shares. Let's go with Micron. I know this one has options. As you see, my Fibonacci retracements are on the chart already because I've already marked this up, right? So what I'm looking at on Micron is a pullback to that 87 level. I literally took it a day late. I did the video the day before this candle, and Micron took off, right? This is the one. Like, I should have bought it that Friday before the video I made, and I would have been like, this would have been an amazing trade already on Micron, right? It's like they were watching my video, and on Monday, pre-market, it took off. But if we're looking at the option chain, say like January, this is a year out. You got some liquidity here in the January 16th, 2026 strike at a pretty high delta option. Even this one here, 833, it's not as liquid as this one, but I like my highly liquid options. You could control 100 shares for, let's see, the last is like $3,600, $3,700 versus if you were to buy 100 shares outright, that would cost you $10,000. So you could potentially buy 3 of these, or I'm sorry, this strike, this at the 70 strike, you could buy 3 of these and control 300 shares for approximately $10,000 versus only buying 100 shares for 10,000, which is why I like buying leaps, because you can use your money, there's more leverage, right? For the same amount of money, I can control 300 shares versus controlling 100 shares for the same amount, right? So I would personally look at that 70 strike if Micron gets back down to this 87 level, which is where I wanted it in the first place. What's something else? AMD is another one that I'm looking at, right? If it gets back down to this level, it's at a 60% discount. Just to go back to Micron, Micron would be same thing, around a 60% discount. I've already checked the fundamentals on these companies. If you go look at my video from last week, this is why I like these companies. They're fundamentally sound, but they are discounted right now. AMD is at a 60% discount off its all-time high. And I would really want it at 110, and it's getting close there, right? It's came down. I love the semiconductor market just in general. This is the number 2 player behind NVIDIA as it relates to GPUs. And it's a profitable company that has been growing its earnings. So this is why I'm like, hey, this is a great company to own that's 60% off that actually has been making money, right? So this is where I'm like, so the stock price is diverging from the actual value. That's what I'm looking for. So if AMD gets down to 110, which it could next week, if it's a big down day in semis, I'm going to be looking at the options chain. All right, so if we look at the January 26th option, AMD is liquid right here at the 80 strike. That's a year out. So to control 100 shares is $4,500, right? To control 100 shares by buying the shares, it is $11,000. So you could potentially buy 2 or 3 of these contracts for the same amount that it would cost you to buy 100 shares. So I would buy this one at the delta. This is my strategy. Some people want to go for the cheaper options. I like buying higher delta options because the theta, the time decay, especially as you get closer to expiration, is going to be lower, and there's going to be less time decay in this price and more intrinsic value, right? The actual value of where it is, because right now AMD is at $116. Of course, I would want to buy AMD for $80 if the current price is 116, right? So this is what I'm looking at to buy if it triggers. If AMD hits 110, I will probably be buying a couple of these, 2 to 3 of these in my retirement accounts, potentially next week if we get a drop to that 110 mark. And then OpX might be a good volatility event where it might actually get down there. And I will feel comfortable even if it goes a little bit lower. Why? Because I'm not buying something at an all-time high. Imagine if you bought AMD at $227. You'd be pissed right now. You would be calling AMD the worst stock in the world. You'd be saying, I hate trading. I'm taking my money out. I don't know what I'm doing, right? Because you bought something at an all-time high. Versus me buying AMD at $110, that is severely discounted, and I got all of this room for AMD to come up in a market that I think is going to be growing over the next 5 to 10 years, which is the semiconductor market. I got the number 2 player in graphic design chips that has an amazing CEO that has been growing earnings. That's the type of leap that I want to be in. And then we talked about the January 16th, but 2026, but you could potentially go further out and see if there's any more liquidity. I don't see any liquidity in the June. Maybe this one right here, the 100 strike. And if we go a little further out, 2 years out, even less liquidity, but except maybe the 100 strike as well. So if you wanted to go further out, you can take the December 18, 2026 100 strike, especially if you really believe in NVIDIA over the next, or NVIDIA or semiconductors or AMD over the next couple of years. The June 18th, you could potentially take the 100 strike, a little less liquid, but I like the January 16th, which gives us an entire year. and you got plenty of liquidity at these higher. So I would probably take the 80 strikes because I like going deep in the money with my leaps, right? But this is still less expensive. Buying even one contract controlling 100 shares is way less expensive than buying 100 shares of the stock outright, right? So I could get in this trade for $4,500. This is going to take me 11,000 to buy 100 shares, right?
I just want to confirm you're buying a call on that, right?
Yeah, I'd be buying calls on AMD. But this is
Yeah,
the
I've
one
been
that's
looking at AMD.
this
I
is the
like
one
it.
that's closest to triggering on a leap. I thought Micron was close, but it took off that next day. But AMD has been coming down, and it's the closest to my trigger price. So AMD, I would say this is my highest probability trade. Once again, we talk about the fundamentals. Damn it, it's doing it again. Oh, it's because I'm in that mode. All right. If we're talking about fundamentals of AMD earnings, look at the last 4 quarters. It's been meeting or beating expectations on earnings per share, and it's been growing revenue consistently. December 2023, and we had a chip fall, right? And I think there's certain chips are cyclical too. So it was making 6.14 billion. Then goes down a little bit, 5.45 billion. You got to look at the annual revenue increase, 5.72 billion, and now 6.71 billion, right? So it's been growing consistently. It looks like this quarter at the end of the year tends to be the bigger quarter, but it's been growing revenue consistently and beating expectations. And more than anything else, if you look at this last quarter, revenue's up 17%. Net income profit is up 157%. Earnings per share up 161%. The margins, net profit, not gross margins, they're up 119%. Operating income up. Cash up. Company looks good, right? It doesn't look like a failing company to me. If it's making, $5 to $6, $7 billion a quarter, and it's growing revenues, and so all of these arrows are green, and the stock price is going down. So that's what I want to see. A good company fundamentally where it's undervalued. And so if it hits that 110 next week, I'm in. And
What
then
do you believe is? I'm
even,
sorry to cut you off.
even looking at the RSI, look at how exhausted it is. Here, it's under 30. Anything under 30 is exhausted right here at this point. It hit that exhaustion level over a long-term period, right? And if you go look at, we zoom out, the last few years when it hits that level, it tends to bounce, right? Here, it hit that same level, it bounced. Here, it bounced. Here, it bounced. So I'm just looking at the historical pricing of it. If it hits that level of exhaustion, it tends to bounce after that. Go ahead, Ange.
I was wondering, what do you think was the cause of the stock price to decline from such a high price and for so long?
People going into people probably trading Nvidia, AVGO, and TSM,
Mm.
right? Because that's what I did. I used to own AMD, and then I sold that, and then I bought Nvidia.
Mm.
But this is the number two player. At some point in time, I think, and this is me talking against my own long term book. This could be 5 years down the line. There's going to be a secondary player in the GPU market.
Yeah.
AMD is the secondary player right now. Their chips aren't as great as Nvidia, but they're number two. And if you don't want to spend $14,000 to $40,000 on a chip, you can get an AMD chip probably for 5 to 10. You know, so
Yeah.
they're going to be the secondary player. Their chips are going to get better. They're investing in AI chips too. They're actually probably leading in the gaming market. In terms of your Xbox, PS5s usually have AMD chips. Your PC market as well. The better PCs tend to have AMD chips over Intel chips from a GPU standpoint because Nvidia chips are too expensive. So I like them as a secondary player, and I just showed you their finances and their balance sheet. Like they're growing revenue. So I'm seeing a divergence between price and like them actually growing revenue. So at some point in time, I think they can get back up to this 186 price, 200 price, right? And so if I go from 110 to like 186 to 200, I can make really good money from there, even if it doesn't even get back to its all-time high. But that's what I'm looking at as a really good company from a fundamental standpoint that has a divergence in value from stock price. And Nvidia, I would love to buy more Nvidia stock, but Nvidia is at all-time highs.
Yeah.
So that's not a good value to buy right now, unless it comes down further. A better value would be AMD or Micron, which was way up here, and it's coming back up. I just wanted to. I hope it comes back down to 87. And same thing with Micron. Those two are actually like they have good earnings, right? So these aren't companies that I think are going to go bankrupt next year. They're not going to be Intel or uh, Bath and Body Works or a lot of the Bed Bath and Beyond. Like this is a company that still makes money and is growing earnings. So this isn't going to go to zero, at least anytime soon. Chances are it's undervalued and it's going to keep going up. And it's just because the semiconductor market had a bad few days, so it's going with the entire market. But if we're talking about value, we're talking about exhaustion, AMD is there. So that's why it's on my list. And so, like, let's say if I did buy 3 contracts at that January 16th, 2026 expiration date. If I were to buy 3 contracts there, then I'm looking maybe to scale out one here at 132, right? Because you see a bunch of resistance here at that fib level, that 50% fib level. One day here, day here, day here, day here, day here, day here. So I might buy it at 110, that leap, scale out here, leave 2 runners, hopefully scale out again here, and then keep that other one and let it see where it goes.
Take it to the moon.
Yep. Because especially if it gets back up to that 154 level, I might just keep that one and then put a stop on that last one at 110, and just let it run. Just in terms of how I might potentially trade that. But I see a bunch of resistance right there at that 132 level. So I would probably, if I bought 3 contracts, I would scale out a 1 right there. Because look at all that resistance. That's not to say it won't break through resistance, but it's going to at least it's going to be a stop right here where it's going to probably consolidate and try to break through that level unless some amazing news comes out or something like that. But that's how I would trade it. All right, so let me. I know we're running over this week. I'm trying to get y'all some gems. Let's go back. So that's my 4th strategy: leaps. Try to hold them at least 3 months before expiration, or the ones I got now are doing so well, I might hold the shares. I want them to actually convert into shares, right? So for next week, in terms of the weekly stock picks, disclaimer, and this is for this entire YouTube. I know we're an hour in, but investing is risky. This is for informational purposes only. Trading is risky. Do so at your own peril. I am not an advisor. I'm an attorney that just happens to trade in my spare time and invest the money that I do make, right? So do your own research. The purpose of this channel is so that you can start to do your own research, so that you don't have to rely on a stockbroker or whatnot to tell you what's going up or go down. You can just go look at the chart. You can go research the earnings of a company and then learn whether or not this is a company you want to invest in or trade. What am I looking at next week? I've told you. Not much is positive. This is a snapshot from Koyfin, KOYFIN.com. This is and I go look at the U.S. sectors and go look over the last month, the last 30 days, at least for my swing trading, to figure out what's up and what's down, what's trending, what's not trending. There's not much trending to the upside right now. Last week, SMH was the closest. That's the only thing that's positive, but it's not doing so well. The only other thing is oil services, and even that's like right? Because energy is negative, and those have a lot of the same stocks inside. So I don't really like much of anything to the upside right now next week, which is why I'm giving you guys plays to the downside. XME has been the most negative. I missed that FCX trade next week. I'm looking at Alcoa next week or XME if it has some liquidity in the options chain on the put side. KRE kind of sort of runs with the Russell. XLB, which is building materials, I believe, materials. Uh, XLP, which is consumer staples, and XLY, which we kind of talked about last week. So those are the sectors that are down the most. XLI, XLP, XLB, KRE or the Russell, and XME. So metals companies, miners, things of that nature. So that's what I'm looking for to the downside. I've already shown you what I'm looking for on the downside in XME. But like, let's look at the KRE. Same thing. What do I mean? So is this trending down? Yes. We had a low here, a lower low here, and a lower low here. So XME is kind of, or KRE is trending down. These are regional banks, especially if you look from its high here, right? We keep going down. So what am I looking for? And I'm looking for a mix of like what the ATR is for that particular day, and is there some level with some volume, like right here, where it seems to be a ceiling, right? Or some resistance. When you're talking about resistance, if you hear resistance, like where is it hitting and then coming back down? So if KRE gets close to like 6150, that's where I'm looking to potentially short it if we have a big candle up to the upside, right? XLB, same thing. I already have this marked off. If it comes up to $85, I'm especially on a big green candle, I'm looking to short it there. Once again, you got to go look into the options, see if there's any liquidity. January 17th seems to be liquidity, but there's a large spread between the bid and the ask, so XLB might be off the map. But I would look at this when the market is actually open to see if these prices actually come together a little closer, right? What else was there? KRE. Did we talk about KRE? Yeah, we did talk about KRE, but we didn't look at the actual option chain. KRE is usually pretty liquid, right? In the put side, plenty of liquidity. Looking at the spread, this might be like a think or swim glitch over the weekend. Just check this when the market is open. That's the only reason I wouldn't trade it, is because the difference between the bid and the ask it's more than 10%. So that's going to provide a lot of volatility getting in and out. So KRE may be off if the option chain looks like that, because I mostly trade things with options. What else was there? XLI. Looking at the XLI chart, excuse my kids in the room. XLI looks good for a short next week. I don't like GE for a short. Caterpillar, which can be somewhat volatile, and RTX. So I would be looking at, same as last week actually, I would be looking at XLI, Caterpillar, and RTX for potential shorts. Some of these are going down as well, but just the things that I usually tend to trade that have liquidity. I know Caterpillar, RTX, and XLI sometimes have liquidity. RTX usually has the most liquidity. So trading RTX on a pop-up, that would be on my list. And then XLP was the last sector. I like XLP down to the downside next week. Procter & Gamble to the downside. Not so much Costco. Coca-Cola to the downside. Pepsi to the downside. MO to the downside. Those are on my list for next week. XLP doesn't look good. If you look at most of the stocks inside of the consumer discretionary, they're all heading down. So I want to keep beating up on the weak. So I'm looking for big pops on some of these stocks inside. XLP, PG, Procter and Gamble, Coca-Cola, Pepsi. Those are probably the top of my list. But once again, you need to go look. This is for swing trading. You need to go look at the actual option chain. So like looking at XLP. Plenty of liquidity. Once again, big gaps between the bid and the ask. Watch this during the actual market. It might be because OPEX is on Friday, to be honest. So if we go a little further out, yeah, I might be waiting till Friday on a lot of these names because OPEX is coming out, which is a volatile period. So let's look at Coca-Cola. Coca-Cola looks good. There's a lot of liquidity and not a huge gap between the bid and the ask. So Coca-Cola is probably top on the list. And then Pepsi, same thing. Pepsi has a lot of liquidity. Earlier in the week, you could take these. Not a huge difference. More of a difference between the bid and the ask than Coca-Cola. So I like Coca-Cola more, but I like Coca-Cola and Pepsi next week to the downside. Right? And look, downtrend, you want a big green candle up to the pop. I got a Pepsi at a level at 150, where if it pops up to 150, I want to take it back down. Right? All right, that's pretty much it for this week. That's what I'm looking at. I'm not really looking at much of anything to the upside because January is a weak it's a weak time for the market generally from like a seasonality standpoint. And so you'll see also in the market that there are certain times when the market tends to be strong and certain periods when the market tends to be weak. That isn't all the case all the time, but what we're talking about is just like probabilities. Here's a site called trade.swing.com. I'm just looking at like seasonal patterns, right? So S&P is like the general market, has the most sectors in it. Weak months tend to be January, beginning of the year, right? Same thing for just the NYSE composite, January. NASDAQ can be strong in January, but February it's weak. So like the beginning of the year, January, February tend to be weak points for the market. So if I'm shorting or I'm buying puts, the January, February is probably when I'm buying them.
Do me a favor, fam. Throw that. I want that link on the chat, please.
All right, that's it for this week. Any questions? We're kind of running over, and my children want me. So
Good game. Appreciate you, fam.
all right,
All right, mama.
Mokama Sunday service. Making it rain without the umbrellas. We are here every Sunday, 8 a.m., talking about the market. Yep, I'll see y'all next week. Be safe with the fires and stuff out there, especially for y'all that live in LA like we do. All right.
Peace.
Yeah.
Yes, sir. Tap in.
Take it easy, man.